Thanks, Anna. So now for our final presentation today, we're very happy to be joined by Alejandro Esteller-Moré. Alejandro is Professor of Economics at the University of Barcelona and co-director of the taxation area at the Barcelona Institute of Economics. So his research has been published in a wide range of journals such as Fiscal Studies, International Tax and Public Finance, Journal of Public Economics, and so on. He's advised institutions including the European Commission, the Catalan Tax Agency, the Barcelona City Council and the Government of Andorra. So Alejandro, we're very happy to have you here with us today. He's going to talk to us about the Spanish experience of wealth taxes.
Okay, so good afternoon already. No, still good morning. So thank you very much. Yes, I am Alejandro Esteller-Moré from the University of Barcelona. And first of all, I would like to thank the Irish Fiscal Advisory Council for the invitation. And I will explain the Spanish experience with the net wealth tax. And we have a lot. For better or for worse, we have a lot of experience, you will see in a moment. First of all, I would like to explain about the institutional setting. And I must say that we in Spain do not have a single net wealth tax, but we have 20 net wealth taxes. So we have 20. Why? Because the central government enacted the tax in 1977 with the restoration of democracy, but this tax was progressively transferred to the regions, to the so-called common regime regions, and we have 15. Therefore, we have 15 net wealth taxes, up to the point that the Autonomous Community of Madrid at some point abolished the tax with a 100 full tax credit. It means that they have regulatory power. So we have 15, but on top of that, we have the so-called specific, what we call, special tax regime regions, which are the Basque Country and Navarre. These amount to other 4 regions, so we have up to now 19. In 2022, to reduce a race to the bottom, the central government established the so-called tax on large fortunes. So this is the number 20. This later tax, the tax on large fortunes, which provides a credit against the regional wealth tax, is intended to encourage regions to levy or maintain the regional tax, thereby preventing, as I told you, a race to the bottom. So this is a first lesson. The tax in Spain is decentralized, and there have been a lot of tax competition among regions. That's the reason why the tax on large fortunes was established in 2022. Having said this, we are the only European Union member state with a periodic, general and progressive tax levied on personal wealth. Some relevant legal details. There is a large minimum threshold. I will talk from the point of view of Catalonia because remember we have regulatory power. And the minimum threshold is 500,000 euros. This means that every year there are about 80,000 declarations, which means around 1% of total population or 2% of PIT returns submitted. It's a general tax, but we have exempt assets, for example, pensions, primary residence up to 300,000 euros, family business assets under certain conditions, and this is a very important margin of avoidance, and Spanish historical heritage assets, masterpieces, and antiques. Another legal element, which is very important, is a limit on the tax liability to avoid confiscation, which is a principle set in the Spanish Constitution. This works as follows, and it's very important, that's why it's in red, as you will see later. In practice, it works as follows. The sum of the net wealth tax liability plus the personal income tax liability cannot be larger than 60% of personal income, excluding long-term capital gains. So rich people can perform or can change their structure of income, moving short-term capital gains into long-term capital gains in such a way that personal income is lower and the limit is more binding. So they reduce the tax liability. This is very easy. You are not Spanish But obviously, everywhere in the world does not want to pay taxes, and if you Google, the first way to avoid the tax in Spain, advised by tax consultancies, is to do this, because it's very easy, and we'll see that we empirically estimate the importance of this margin of avoidance. If the sum of liabilities exceeds 60%, the net wealth tax is reduced up to a minimum 20% of the original tax liability. Another important element is obviously the tax schedule. It's a progressive tax schedule, and then tax rates range from 0.21% till 3.48%. For heuristic purposes, here we can see the marginal tax rate directly from the schedule, and here I calculated some average tax rates. However, I would say that there is another way, there is another way to present the data in terms of heuristics. Because when you see this data, 3.48%, some people believe this is not very big, but they are doing some wrong comparison, because they are comparing the marginal tax rates of the personal income with the marginal tax rates of the net wealth tax. The tax base is totally different. This is much larger. So here, for heuristic purposes, what I'm doing is transforming the marginal tax rate on wealth on a marginal tax rate on personal income. It's very easy. You just have to divide the marginal tax rate on wealth by the annual return to capital. In this way, as an example, if we get the 3.48 tax rate we saw before in the schedule and suppose return to capital of 6%, this means that the implicit tax on capital income is as large as 58%. This is supposing the annual return to capital is 6%. So imagine if the annual return to capital is half, 3%. This would mean that the implicit tax on capital would be double the 58%. This is large, I guess. Everybody would think this is large. So it's immediate to conclude that I would expect many reactions, many behavioral responses by taxpayers. In particular, because this tax affects the ultra-rich people, okay? So they have more means to avoid, to evade, or to do whatever they like to reduce the tax bill. So this is important. It's another takeaway. Be aware of the tax rates. They can be as large as 58%. Here in this graph, I have depicted the implicit capital income tax rates for a wide range of taxable wealth levels. Instead of using the annual return to capital equal to 6%, I have used 2% and 4%. On the vertical axis, you have the implicit tax on capital income depending on the annual return to capital, and you see that the lower the annual return to capital, the higher the implicit tax on capital income, and it can be as large as 100%, okay? This is the theory. However, the story is even more complicated because we in Spain, we also have a personal income tax. So if you have savings, you have to pay the explicit personal income tax on savings, and on top of that, you have to pay the implicit tax on capital income through the net wealth tax. The blue line is just the personal income tax rate for different levels of wealth for the personal income tax, and the tax rates range from 19 to 26%. This is the blue line. The orange line is the sum of the explicit tax on capital in the personal income tax plus the implicit tax on capital income we calculated in the previous slide. At some point, you see this is flat. Why is it flat? Because of the limit on the tax liability to avoid confiscation that we explained before. In any case, this is the takeaway, the final takeaway about tax rates. The total amount of taxes that capital income, in theory, because everything here has to do with statutory tax rates. This is statutory tax rates. It can be as high as 60%, while the top tax rate on labor is, in Spain, 48%. I wouldn't say it's greater than 50% as we showed in the previous slide, but it's anyway 48, 50%. Here is 10 percentage points higher. This is in theory. Why? Because in practice, and I will read literally, the effective tax burden is substantially reduced through the use of tax loopholes, aggressive tax planning, and illegal evasion. This is the reality. This is theory, but the reality is totally different. Then, what we have learned from the Spanish net wealth tax. I will provide some graphical evidence on the next slides. In red, I try to highlight the potential of the tax. However, this reality is subject to important conditions that may be difficult to meet. The first lesson, under perfect assessment of the assets that you have to pay out of them the tax, under perfect assessment, this is an ideal situation, under perfect assessment, and no evasion, another ideal situation, you will see next. For each euro collected via the net wealth tax, about 35 euros are collected via the personal income tax. And this is the upper bound. In practice, the ratio is 78 versus 1. Therefore, there is a modest revenue capacity by the net wealth tax. I wouldn't say by now that the future of taxation of the public sector has to be dependent on the net wealth tax. At least not on the Spanish net wealth tax. Maybe on the Irish. Maybe you open a new window, a new frontier. But the Spanish net wealth tax is not very good. But I came here to try to say what's going on with the Spanish net wealth tax. In any case, on top of that, the tax gap is quite large, particularly at the top of the wealth distribution. We'll see next. Avoidance is pervasive. This includes mobility. Mobility is a source of avoidance. It's legal, but obviously reduces the tax bill. In Spain, across regions, this is no longer an issue because of the tax on large fortunes. However, it's still an issue between countries. I am advising the government of Andorra. I don't know if you know Andorra, but it's a low tax jurisdiction. It's very easy. You move to the other side of the border and you pay no taxes and obviously not the net wealth tax. So mobility at the international level is still a big restriction for this tax. And there is some redistributive capacity. I will explain the level of redistribution that this tax might be able to achieve. So here, evasion, I told you. Evasion, particularly at the top, is very large. We, for the Catalan Tax Administration, estimate every 4 years the tax gap of the net wealth tax and other taxes. This is what the literature calls a full Monty, and it's a way to provide information to the people, because people may think that evasion is very large or very low. Here we provide estimates. The tax gap for the net wealth tax in Catalonia is 35 euros. It means that out of a potential of 100 euros, 35 euros go uncollected, okay? The main reason of this gap is due to the location of financial assets offshore. This is more than 90%. This is more than 90%. Why is that? Because the rich people do not need to evade. Apart from this, because they can take advantage of the loopholes, okay? But this is only evasion, illegal. This is illegal, so 30% remains uncollected. The amount of money uncollected because of the gap is basically due to the 10th decile. So 84% of the gap is due to the very rich people, according to the Catalan standards. It means that those people whose gross wealth is above 4 million euros. Okay? Avoidance is pervasive. Here, we took advantage of the reintroduction of the central tax because for a short period of time it was abolished, and in 2011 it was reintroduced. So we take 2011 as the benchmark because it was with a surprise. People didn't have time to react to the reintroduction in 2011, so this is the benchmark. This is the normal situation of taxpayers. 200, 300, 5 years after their reintroduction, therefore after the increase in the tax burden due to be owner of a stock of wealth, the use of the limit increased and the number or the amount of XM assets increased. So it means there was a big reaction by rich taxpayers to reduce the tax bill through these margins of avoidance. It's not illegal, but obviously tames the revenue capacity of the tax. And if it tames the revenue capacity of the tax, it reduces the redistributive capacity of the tax, okay? And avoidance is pervasive. We have another study here. We got the universal data, the universe of taxpayers in Catalonia. The red line is marking the moment of an audit. We were able to compare the reaction of taxpayers after an audit with respect to those similar taxpayers who were not audited. So on the right-hand side of the vertical line, we see that 1, 2, 3 years after the audit, those who were audited comply more. So they behave well, okay? The net tax liability went up, but the 4th and the 5th year later, they went back to the previous situation. And why is that? Because they started doing avoidance. So we are no longer, or we are never a good lesson, or we are, how would I say in Spanish? I'm sure I would be able to say that, but you understand me. It's not a good example of Spain. This is the reason. Okay, we have a tax with a lot of loopholes. You can do the deterrence, but you see, at the end, we are back because we have a bad tax. Okay, so it's not sufficient with having a net wealth tax. You have to have a good tax. And this is not a good tax. Okay? Sorry, but I had to say it. This is the revenue capacity of the tax. We constructed a fiscal simulator, in this case for the whole Spain, and just to have an idea, just in terms of the ideal situation. This is telling us that if we have a perfect assessment, if we have no evasion, this is an ideal situation. And we have the current tax, this is an ideal situation. So this is an upper bound. In 25 years, because we have to, let's say, assess the level of redistribution in the long run, okay? In 25 years, the concentration of wealth in the top 1% would go from 11.5 till 18.14. So this is what an ideal net wealth tax could achieve if there were perfect assessment and no evasion, okay? If there were no avoidance, it could be reduced from 18 to 17.95%, a little bit more. I don't have any other benchmark. I don't know to what extent other tax could perform better, but this is an absolute assessment of the redistributive capacity of the net wealth tax under the ideal situation where there is no evasion and there is perfect assessment of all the assets under taxation. This is what the tax can achieve. Obviously, in this case, there would be more revenue collected, about 3 times what is currently collected. All in all, any lesson, any good lesson from the Spanish experience? No good lesson from the Spanish experience, sorry. Any bad lesson from the Spanish experience? Yes, I think. In any case, I don't want to push much. I don't want to give the answer. I think you have the information, and if you want to enact a net wealth tax, good luck. But I want to finish with a question. Is this the best tax to reduce wealth concentration? When I say this, I mean the Spanish, and I think it has been clear that it's not. However, it might be the best tax, or one possible tax, as long as we have enforcement capacity. We promote enforcement capacity. However, what happens? Another bad experience from Spain. If you remember, the most important source of evasion of the tax gap is due to financial assets offshore. The regional government of Catalonia cannot deal with this. Only the central government. So, therefore, there is evasion, but the regional government has been assigned a responsibility to enforce the tax, and we cannot do anything. So now we are working on what is the optimal gap. And in the case of Catalonia, there is very little room for more enforcement. Why? Because the main source of evasion, you cannot deal with that. It can only be dealt with by countries, and Catalonia is not a country. So conditional on enforcement, and I would say conditional on the right allocation of enforcement capacity. And design adjustments, okay? There are a lot of exemptions, but in Catalonia and in Spain in general, it's not a matter of exemptions. It's, for example, the main margin of avoidance is the limit liability, that the tax, the net wealth tax liability and the personal income tax liability cannot be larger than personal income, because people, what they do is simply to transform short-term capital gains into long-term capital gains. Some good experience, yes. For example, in the Basque Country, they define in a different way the limit, and they do not exclude long-term capital gains. They do things well, the rest do not as well as they do. So that's the Spanish experience, the bad experience, that's it.